This is what the question says. Peter Chawawa started a retail business on 1st January 2012. He has not been filing income tax returns for the 6 years to 31st December 2017. Now, an investigation of his affairs revealed the following. 1. The balance sheet of the retail business as at 31st December 2012 was as shown below. So we have the fixed fixed assets, which consists of premises 2,000, furniture and fittings 1,000, motor vehicle 500, current assets given, debtors, bank balance, cash in hand. Then total assets. We have the capital as at January 2012, net profit for the year, drawings, mortgage loan, creditors. Number 2, he constructed an extension to the premises in the year 2016 at the cost of 625,000. The following accounts balances were outstanding in the respective years as shown below. So we have the trade debtors, bank balance, trade creditors, cash in hand, stock. He withdrew goods worth 5,000 per month per annum from the business for his personal use. The principal repayment on each mortgage loan amounted to 250,000 per annum from 31st December 2013. The mortgage interest paid in each of the 4 years ending that 1st December 2013, 14, 15, and 16 amounted to 100,000, 75,000, 50,000, and 25,000 respectively. His wife opened a saving account in a commercial bank in the year 2012. The balance in the account after crediting the interest earned were as follows. 2013 all the way to 2017, we have the saving account interest earned. Then his living expenses and wear and tear allowance were agreed with the Revenue Authority as follows. So we have the living expense, the wear and tear. So we are required to compute annual income of Peter Chawawa from 2013 to 2017. So here again we see that we have been given several assets and several liabilities, and we are required to get the taxable income. So the first thing that we normally take, we note which years are we getting the taxable income. It is from the year 2013 to the year 2017. So now we have to determine if you are given the capital by the beginning of 2013. Yes, it is given in additional information number 1 because we are given the balance sheet as at 31st December 2012, which obvious the balance sheet has the capital, the assets and liability. So if you look at the capital, we cannot talk of 3,000 because that is capital as at January 2012. So we want at the end, which was now that at the beginning capital, net profit for the year less drawings, you get 2,800. That is the capital now at the end of 2012, which marked the beginning of 2013. When the time comes to use it, we'll use it. So the rest we have to now, since we are not given the capitals for each of the year, take the assets minus liabilities. But if you look at the ones that are for each of the year, they are in point number 3, that the following accounts balances were outstanding in the respective years as shown below. So where we have trade debtors, the bank balance, creditors, cash in hand, and stock. But if you look at the characteristics of those assets and liability, they are current one. We don't have fixed assets and fixed non-current liability. So we have to confirm if we had them. Yes, we had them. If you look at the balance sheet of December 2012, there are fixed assets, 3 of them. Those must be carried in the subsequent years automatically. And when it comes to the premise, as per additional information number 2, we have an addition in 2016. So we just add. Otherwise, the others will be the same for those years. When it comes to the non-current liability, we can only find one, the mortgage loan of 1,000 as at 31st December 2012. So that should be in the subsequent years, except that in additional information number 5, we are told that the principal repayment on each mortgage loan amounted to 250,000 from 31st December 2013. So it was being paid 250 every year. So we'll be reducing by 250 every year. Otherwise, we post them as they are. So we'll have Peter Chawawa capital statement. So we have the years that we are required to get: 2013, 2014, 2015, 2016, and 2017 as per the required in the computation of taxable income. And I want us to convert them to shillings thousand. We start with total assets. So first of all, we'll bring forward the non-current assets, which we have premises, 2,000, 2,000, 2,000. But now in additional information number 2, there was an extension in 2016 of 625. It will be 2625, 2625. And then now the other fixed assets, furniture and fitting, 1,000. Then motor vehicle, 500. Then we now bring forward the point number 3, trade debtors, 173, 190, 28, 230.5, 253. Bank balance, which we have 109, 194, 281, 281. Now for the last year is an overdraft, so we put a dash. We have cash in hand, 10. Stock, 255, 302.5, 332.5, 366, 402.5. Now there's still another asset in point number 6. His wife opened a saving account in commercial bank in 2012. The balance in this account after crediting the interest earned was as follows. Although they are the wife, it is the wife the account, but we are not told that it was a separate or she was not getting money from the business. Because that is not clear, we have to assume she was getting money from the business being given by the husband. So it should be considered here. Remember we said we consider all assets, both commercial and private. So you'd have saving account, 300, 900, 100, 725, and 750. With no other, we will get the total. And then we come to the total liabilities. So we start with the non-current liability in the balance sheet on number 1 as at 31st December 2012. We have mortgage loan, so in additional information number 5, we were told that there was a payment of 250 every year. So here 1,000 minus 250 give us 750, minus 250 again 500, minus 250, 250, minus 250, dash. And then now we bring the current liability. In point 3, first we have the bank overdraft. A negative bank account represents a bank overdraft. So which was in the last year here, 32. And then the other one is the creditors, trade creditors. Trade creditors which you have to 30, 241, 253, 272, and 291.5. And then we can get the total. So 2,000 plus 1,000 plus 500 plus 173 plus 109 plus 10 plus 255. 255 plus 300, giving us 43, 47. We do the next one, 2,000 plus 1,000 plus 500 plus 190 plus 194 plus 10 plus 302.5 plus 900. 5096.5. The other one is 2,000 plus 1,000 plus 500 plus 208 plus 281 plus 10 plus 332.5 plus 100. Half 44, 31.5. The other one is 2625 plus 1,500. This is already 1,500 plus 230.5 plus 281 plus 10 plus 366 plus 725, giving us 5737.5. Next is 2625 plus 1,500. That is the 1,500 plus 253 plus 10 plus 402.5 plus 750. 5540.5. The other one will be 750 plus 230. 980. Then this will be 741. This will be 503, 272. And then this one is 291.5 plus 32, giving us 323.5. Now we can get the capital at end of the year. That is assets minus liabilities. So it will be 43, 47 plus 980 plus 980 minus, sorry, it should be minus 980, giving us 3367. Next is 50 96.5 minus 741 give us 4355.5. The other one is 4431.5 and then minus 543 at 928.5. The other one is 5737.5 minus 272 giving us 5465. 65.5. Then 5540.5 minus 323.5 giving us 5217. Then now we less capital at the start of the year which for the first year we have to bring the capital that was there, which was 2800. The one in additional information number 1. Now for this one it will be this one 3367. This one will be 4355.5. This one comes here 3928.5 and this one 5465.5. So we'll get the net accounting profit. So we start with this, that figure minus 5465.5 giving us negative 248.5. This one 5465.5 minus 3928.5. 1537. The next one is 3928.5 minus 4355.5. 43. $43.55. 4355.5 giving us negative 427. The next one, this one, 4355.5 minus 3367. 988.5, 3367 minus 2800, 567. Now this will now add non-allowable expenses. As per the question, number 1 does not have an expense. Additional information number 1 was a balance sheet. Number 2 was an extension. Number 3 were assets and liability. Number 4, he withdrew goods worth 5,000 per annum from the business for personal use. So we have drawings. Drawings are not allowable expense, which we are told each year was 5,000. Since they are shillings 1,000, it will be 555. Number 5, the principal repayment on each mortgage loan was 250 per annum from 31st December 2017. That doesn't have any issue. It's not an expense, it's a loan that was being repaid. But there was mortgage interest. Mortgage is used to construct a residential house. So the interest on mortgage is not allowable because it's not for business, it's for residential. So mortgage interest which we are told it's 100, 75, 50, 25. This didn't have anything. The number 6 is about the saving account and interest earned. That's an income, not an expense. Number 7, there is living expense. Living expense are not allowable. $300, 400, 450, 500, and 600. And wear and tear, that's now, wear and tear, remember, is a capital allowance. Capital allowance. So an unallowable ends there. We now less capital allowance and non-taxable incomes. And we start with capital allowance. We said capital allowance is the wear and tear. So capital allowance or WTA. So we deduct, we have 155.5. We have 130. We have 109. And then 73, 157. The only thing that remains is the non-taxable income. So we continue here, 2013, 2014, 2015, 2016, 2017. So we now look for the non-taxable income. There was only one income in the question. In number 6, interest earned from saving account. That, if you look at what we said when we were looking at the taxation of the business income, interest earned by an individual from a bank is a qualifying interest. Withholding tax is final. So that we need to remove because we should not be taxing it again. So interests from bank saving account, which we have 300, 900, 100, we have 725, and we have 750. The interest are 25. These are saving account. We are looking at the interest, 75, 90, 70, 60. And 60. Now with nothing more, we can get net taxable incomes. So we add them. So we'll start from here, 567 plus 105. This actually 405 plus 405 minus 155.5 and then minus 25. 791.5. Next, 988.5. And then this is 80, 480 plus 480 minus 130 minus 75. 1263.5. Next, negative 425.7. 427. And then this 500, 505 plus 505 minus 109 minus 90, negative 121. Next is 1537. This 525, 530, so plus 530 minus 73 and also minus 70. It will be 1924. Next, negative 248.5. That is negative 248.5 plus 605 minus 157 minus 60. We have 139.5. Yeah, so that is how you determine the taxable income using the capital statement under the tax investigation. So that brings us to the end of this topic. Until I see you in our next the next lesson, see you then. Have good time. Thank you.